Inside the Lehman Brothers headquarters on 7th Avenue, 25,000 employees are about to find out their jobs no longer exist. Their pensions? Gone. Their stock options? Worthless. On the trading floors, people are crying, packing boxes. Security guards are already changing the locks. In the same week, $10 trillion in global stock market value will evaporate. 8 million Americans will lose their jobs. 10 million families will lose their homes. And the people who built the machine that caused all of this, the bankers, the executives, the regulators who looked the other way, almost every single one of them kept their bonuses, kept their homes, kept their freedom. Not one senior Wall Street banker went to prison for the 2008 financial crisis. Not one. To understand what collapsed in 2008, you first have to understand what people believed was being built. The early 2000s were, by almost every visible measure, a golden age for American finance. The Dow Jones was climbing. Housing prices were rising every single year, without exception. Homeownership in America hit an all-time high of 69.2% in 2004. Wall Street was minting millionaires. The big banks, Bear Stearns, Lehman Brothers, Citigroup, Goldman Sachs, Morgan Stanley, were reporting record profits year after year. And at the center of this boom was a product almost nobody outside of finance had ever heard of. A product so complex, so deliberately obscure, that even the people selling it didn't fully understand what they were selling. It was called a mortgage-backed security, and it was about to change everything. Here is how the machine worked. A family in Ohio wants to buy a house. They go to a mortgage broker. The broker gives them a loan, sometimes with no proof of income, no down payment, no verification of any kind. These were called ninja loans. No income, no job, no assets. Approved. The broker doesn't care if the family can repay it, because the broker immediately sells that mortgage to a big bank on Wall Street. The bank bundles thousands of these mortgages together, good ones, bad ones, reckless ones, into a single financial product called a mortgage-backed security. They sell slices of this product to pension funds, insurance companies, and investors around the world. The ratings agencies, Moody's, Standard & Poor's, Fitch, are paid by the banks to rate these products, and they rate them AAA, the safest investment on earth, the same rating as U.S. government bonds. The investors buy them by the trillions. The banks collect their fees. The brokers collect their commissions. And the Ohio family, whose mortgage was sold 3 times before they made their first payment, has no idea any of this is happening. This is the story of what actually happened. Who knew? Who profited? And why nobody paid? By 2004, the FBI was already alarmed. In September of that year, FBI Assistant Director Chris Swecker publicly warned Congress that mortgage fraud had reached epidemic proportions. He predicted that if left unchecked, it had the potential to become a financial crisis. Congress did not act. The Federal Reserve, under Chairman Alan Greenspan, had the legal authority to regulate the mortgage industry. Greenspan believed the market would regulate itself. It would not regulate itself. By 2006, 40% of all new mortgages were subprime, loans to borrowers with poor or no credit history. The housing market had become a $13 trillion time bomb, and the fuse had already been lit. In 2004, a 35-year-old trader at Deutsche Bank named Greg Lippmann sat down with a stack of mortgage data and ran the numbers. What he found was extraordinary. The default rates on subprime mortgages were already rising, quietly, steadily, even while housing prices were still climbing. The two things were moving in opposite directions. That was impossible in a healthy market. He did it anyway. He purchased $1.3 billion in credit default swaps against mortgage-backed securities, essentially, insurance policies that would pay out when the mortgages failed. Then he waited. While Burry and Lippmann were quietly betting against the market, the banks were doubling down on it. Lehman Brothers, under CEO Dick Fuld, had leveraged itself 30 to 1. For every dollar of equity the bank actually owned, it had borrowed 30. This meant a 3% drop in the value of its assets would wipe out the entire firm. Citigroup was holding over $55 billion in subprime mortgage exposure, far more than its executives admitted to the board. The CEO, Chuck Prince, was famously quoted in July 2007, "As long as the music is playing, you've got to get up and dance." The music was about to stop. In 2006, U.S. housing prices peaked. Then, for the first time in decades, they began to fall. Slowly at first, then faster. And the mortgages inside those AAA rated securities started defaulting, not in small numbers, but by the hundreds of thousands. In March 2008, Bear Stearns collapsed. The fifth largest investment bank in the United States ceased to exist in 72 hours. The Federal Reserve brokered an emergency sale to J.P. Morgan Chase for $2 per share, a company that had been trading at $170 per share just 12 months earlier. This was the warning shot. Treasury Secretary Hank Paulson met with the heads of every major Wall Street bank. The message was clear: Bear Stearns was not an isolated case. The entire system was exposed. The banks had a choice. They could begin unwinding their riskiest positions. They could raise capital. They could come clean about what was on their books. Instead, Lehman Brothers CEO Dick Fuld went on television in April 2008 and told investors the worst was over. He called the firm's balance sheet fortress-like. 6 months later, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. $691 billion in assets. Gone overnight. The week of September 15, 2008 is unlike any week in modern financial history. Monday, Lehman Brothers files for Chapter 11 bankruptcy. Global markets open and immediately begin falling. Tuesday, the Federal Reserve and U.S. Treasury announce an $85 billion emergency bailout of AIG, the insurance giant that had sold credit default swaps on $440 billion worth of mortgage securities it could not pay out. Without the bailout, every major bank in America would have lost its insurance on the mortgage crisis simultaneously. Wednesday, the Reserve Primary Fund, a money market fund considered one of the safest investments on earth, breaks the buck. Its net asset value falls below $1 per share. This had happened only once in history, in 1994. Investors begin pulling money out of money market funds in a panic. In 24 hours, $144 billion is withdrawn. Thursday, Hank Paulson and Federal Reserve Chairman Ben Bernanke brief congressional leaders. According to Senator Christopher Dodd, Bernanke told the room, "We may not have an economy on Monday." This was not a figure of speech. The entire global financial system was days away from a complete freeze. Not a recession. A collapse. ATMs running dry. Banks refusing to lend to each other overnight. The end of normal economic life as the modern world had ever known it. And it had been building for years. In plain sight, behind the numbers, real lives were being destroyed. Between 2007 and 2010, 8.7 million Americans lost their jobs. The unemployment rate doubled from 4.7% to 10%. Black and Hispanic communities were hit twice as hard, targeted by predatory lenders who had sold them the most toxic subprime products at the highest rates. 3.8 million foreclosure filings were recorded in 2010 alone. Families arrived home to find padlocks on their doors, children switching schools mid-year, retirement accounts wiped out. In total, American households lost $13 trillion in net worth between 2007 and 2009. To put that in context, that is more money than the United States spent on World War II, the Korean War, and the Vietnam War, combined, adjusted for inflation. And it spread. Iceland's entire banking system collapsed. Ireland entered a decade of austerity. Greece faced economic catastrophe. The crisis that started in American suburbs swallowed the global economy whole.